This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex, as always, and today we are pleased to welcome on Stephen Stepp, the founder of A Step Ahead Financial. Stephen, we're very happy to have you on today. Initially, in connecting with Stephen, I had kind of talked about a topic which I know we haven't certainly ever covered on here today, which, again, just with the concept of making sure you fully understand the different financial products out there, it's remiss to not even cover annuities. It's certainly a investment product that has been around for many, many generations, longer than I have been alive, certainly, or longer even so than the types of accounts that we administer haven't even been in existence. So the concept is definitely something that's very important to understand. People get a lot of exposure to things like different insurance products, certainly stocks, bonds, mutual funds, what we do on the alternative side with things like precious metals, real estate, private equities. More often than not, the conversation piece of annuities or indexed annuities, specifically what we're going to cover today, just never really gets brought up. And that is, really kind of a disservice to you in understanding the different types of products that are out there and trying to help to build a clear financial vision. And if you're missing something that might be beneficial, again, that is to you, that the detriment of you as the investor. Stephen, thank you very much for being on with us today. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be in your current franchise in life with your investment strategy.
Yeah, well, Alex, thanks very much for having me, and thanks for all the great information and education you provide your listeners. I've been in the financial services business for over 35 years. I actually started out as a life insurance representative for a company called Pacific Mutual. After that, I was a marketing manager for a brokerage manager for Phoenix Mutual, which is a top mutual insurance company. And then about 22 years ago, I basically went out on my own and created my own company, A Step Ahead Financial, so that I could help each client in my own particular way and with my own particular biases, if you will, and kind of have free range on which products and which companies in which situations that I would work, and also be a little bit more selective on the clients that we, took on. I actually, in addition to annuities, I do a lot with a concept called bank on yourself. Sometimes it's called infinite banking. And it's a whole different area for annuities, and maybe a chat for another day. Certainly another great, safe, long-term, it's not so much of an investment, it's more of a life insurance policy and ways of using that and creating tax-free benefits at retirement as well. But today we'll focus on and ever since I got started, I've always been an expert on all types of annuities, whether it's immediate annuities, fixed annuities, equity index annuities, variable annuities, and these are all slightly different versions of the same thing. In terms of helping people maximize retirement income and maximize the cash values in a safe, almost guaranteed way, and also provide the annuities are the only way that I know of creating an absolute guaranteed lifetime income. So at the time you start taking the income, you know exactly how much it's going to pay every month for as long as you live. And that allows you to spend your retirement income in the ways that you thought you would want to.
Fantastic. Yeah. Well, let's kind of start, at the beginning with specifically what an annuity is.
Excellent question. An annuity is basically an insurance company contract that's issued by some of the top life and annuity insurance companies out there. All the ones we work with are all AAA rated, companies, multi-billion-dollar companies that have been around for decades and have done this type of business. But they're basically insurance contracts. Some people consider them an investment, but because they can't really go down, the ones that we sell, can't really go down. Some people don't even think of it as an investment. And they basically fall into three primary categories. One is a fixed annuity, another would be the equity indexed annuities, and then finally, what we would call variable annuities. I'm not licensed for, and I do not use variable annuities for a number of reasons, because those are ones that can go down, and I tend to, my fixture of my business is that we only work with investments that can only go up and they can't go down. And then fixed annuities are regular annuities that usually have a fixed interest rate, like they promise you 3% or 4% or 5%, for a particular period of time, and then they renew at whatever the interest rate is at that time. And then more importantly, most people these days are looking at what's called equity index annuities. And these are annuities that allow you to invest in different markets, such as the S&P 500 or other stock indexes, even real estate and gold are in different indexes. And the nice thing about an equity index annuity is that each year, based on whichever indexes you picked out, if the index goes up, then you get a gain in your cash value of the policy, or the value of the money in your policy. If the index goes down, the company simply resets your account at the new lower number, but the cash value stays exactly the same, and they just reset the index, which actually gives you a greater chance of gain in the following year or following years. So there's no year where you can lose money. It's just years that you can gain money. And if you ever look at a stock chart, whether it's an individual stock or an index or the S&P 500 or whatever market kind of driven index you want to look at, if you eliminate the down years, it's always a very impressive, chart. And you would always love to have your money be that way, where it can go up if the market goes up, but it can't go down if that particular market or markets go down. And that's the great thing about equity index annuities. And most of the annuities that we sell have that, although most of them do have a fixed portion, and oftentimes clients will put some of the money into the fixed side and put the majority of it into the equity index side. And so that's primarily what index annuities are, and what tax deferred annuities are.
Sure. So let's start from the kind of the beginning, and we'll work our way into the indexed annuities, because again, I think that's a little bit more of the more interesting kind of topic of conversation. But for those that are kind of interested in this, basically it's an investment contract with a certain provider that effectually kind of has some type of return that is baked into the underlying contract, and it kind of bridges that gap between maybe like a bank CD, which is just accumulated interest paid out at a certain date for a renewal, versus something like a pension that you might receive for like some type of guaranteed revenue in the future. So when it comes to actually binding an annuity contract, and that's, based from my personal experience, what, I like to make sure people understand is that it's a contractual obligation on, two parties' part. One, that you're not going to just, redeem it, and there are penalties for early redemption that you would have to pay. So, you are looking at something that is going to be a long-term play, which again, has its merits and downsides, but the money that you put into an annuity to get that benefit does have a restriction on just liquidation, right? So it's something to, look at it from a, an analytical point of view, is to bake that into it. Now, what exactly, when you say an insurance contract, because I'm pretty familiar with insurance, how exactly, what is the underlying product that is being insured? Is it basically just the rate of return that it is affixed to that, again, just fixed annuity? Or how exactly does that contract work when someone comes to you and says, hey, look, annuities sound great. Let's just start from the beginning. I give you $50,000. What is that contract between those two parties, the insurer and the holder? What does that look like?
Yeah, great question. And keep in mind, there are over 100 excellent insurance companies out there that offer a wide range of annuities, right? But in general, the equity index annuities or the fixed annuities that we're talking about will have an absolute guaranteed rate, usually, typically these days like 1 or 2%, so that you know that over time there's no way you could possibly lose money. Now nobody's going to get excited about a 1 or 2%.
Yeah,
You
you're not
know,
going to lose money on the value, right? Again, we
right,
always have to take into account inflation and the purchasing power of your dollar. But on the face value, if you put in $50,000, you will be able to extract that at a certain date. Um, to that
right.
point, yeah.
So what the insurance companies do is they take a small portion of the amount that you're putting in the case of an equity index annuity, and they buy options in the equities that you're in the index or the equities that you've selected. So if you pick the S&P 500, which is probably the most popular one, the company puts about 90% in their regular fixed account so that they can meet all their other guarantees of the contract and then guarantee that it won't lose money over time. And they put the other maybe 5% or maybe more, depending on the cost of the options, and they buy options in that particular index. And that way they're covering their promise to pay if the index goes up. They'll make the money on the options in order to pay that. Now, most annuities out there will either have some type of participation rate or some type of cap. So very typically the index will say, we'll give you 100% of the gain of the first 10%. And then after that, that's the cap. That's the most that we'll pay in any particular, given year, regardless of how well the market goes up. So if you have the S&P 500 index, for example, and it goes up 20% and you have a 10% cap, you'll earn 10% that year. However, the nice part is, again, it can't lose money. So if that same index went down 20% in a particular year, your policy you'd have the exact same cash value. And next year, it simply would start at the new lower index amount. And then if the index goes up, it'll go up again. And a lot of people think that, it's maybe kind of an advantage to the insurance company, because if they're capping it at like 10% and the market goes up 20%, what's happening with that other 10%? And wouldn't you have been perhaps better having just a regular indexed account that went up, 20%? But the insurance company really doesn't care so much when they've got their bases covered either way. They're totally prepared to pay the regular 1 or 2% no matter what happens as a guarantee, and then at the same time invest the money in options that will cover them if the market does go up, whatever the index promises are. So they're not really taking a stance. They're simply buying those indexes, and if it works out that all the indexes went up or that index went up, then then they have the money to add that to your account. If the market went down, then you're just looking at resetting it and starting over for the next year.
Now, when you say that they're buying options, especially in the index portion of it, are you talking about like, puts and calls that they're buying, or is it a different type of financial products?
No, they're going out, but as professional, investors, and they have committees and they know exactly what has been promised in terms of the equity index annuity. So it's not something that we as the individual have to worry about. They're going out to do that to cover their bases, if you will, on what they promised with the indexes. Because if they weren't doing that, if they weren't involved in those markets at all, and the market went up 20%, then they'd have to find a way of covering that. So it's a way of an individual can kind of play the market in a safer way. And if the index goes up, they make money. If the index goes down, they don't lose money. And then, over time, the last few years with most equity index annuities, most of our clients have averaged about a 7% return. So the market's obviously done better than that in a lot of the recent years. But it's a pretty good, safe way of earning, 5, 6, 7%. And we have had a lot of clients earn even more than that, but that's kind of on an average. And that's how the insurance companies are doing it.
And with regard to especially index annuities, I know for again, the fixed annuities, it's basically a term of contract at which point, it will pay out and you can either renew, redeem without that penalty. But for an indexed annuity, at least talking in the context of how these things reset, is the benefit paid out on that annual basis. So, 1/1 to 12/31. After that, everything's calculated and then dispersed, and then you have to renew a contract? Or are these, again, just how does that kind of work with the term of an annuity? Are the index ones always on an annualized basis? Are they, do they go out longer? Are they shorter? Kind of how does that work in the context of what people are used to with the more fixed annuity model?
Yeah. Another great question. Most of them are year to year, although within some contracts you can have a 2 year or 3 year version of one of the indexes. But generally, most people are looking at the 1 year index, and then each year looking at the performance of the index and either rebalancing among the different choices, because you could put in 50,000 into an equity index annuity and have 20,000 in one account, 20,000 in another index, and the final 10,000 in a fixed account. Or so you can mix and match however you want. And many of these equity index annuities offer several choices. Now, most annuities are, as you said earlier, a longer term investment play, if you will. The shortest ones that I'm aware of are 5 years, but more typically is usually 7 to 10 years. And so it is looked at as a longer term, investment. And most people end up renewing or rolling them over if 5 years or 7 years goes by. There's oftentimes new and better annuities. So working with someone like me, we will know that. We'll contact the people after the 7 years or whatever is up, and we'll talk about what's out there in terms of rolling it over into a different annuity or a better product, or rearranging the indexes that they're using. And our clients, we actually usually have an annual review with all of our clients. So we're constantly looking at the different annuities and the different indexes that are out there.
Okay, great. So again, it's in the world of annuities, and again, I certainly didn't know that. I would have assumed that indexed annuities were something that had a lockup like the fixed ones. But again, to the point of them typically paying out on an annual basis, then at that point, there isn't necessarily a redemption penalty. You could certainly buy it again, but again, most of the time, are you saying that the indexed annuities are annual in their lockup?
Yes, most of them are.
Okay.
And again, there are some that offer for a particular index, maybe a 2 year or 3 year at a different, different cap rate. And sometimes that makes sense, especially if somebody has a specific retirement goal, it's say in 3 years or 2 years. But most of them are set for, an annual return with an annual review, and then reset to the new index number, and then they're off again. And it's pretty automatic. There's nothing you have to do or renew. You can certainly make changes each year if you want in the allocations, but if you don't do anything, the company will just continue the same thing and just renew everything the same way for the next year. And again, most of our annuities are 7 year to 10 years. So when the 7 years is up or the 10 years is up, there's often new and sometimes better annuity choices, and you can roll that money into a new annuity. Now, one thing that I think you may have been alluding to is that almost every annuity has what they call a surrender charge, and it's usually a declining amount from the original, balance, and it's usually stated as a percentage of the original balance. So, for example, a 7 year might have, as an example, a surrender charge. If you surrendered the entire amount of the annuity all at once in like year 2 or 3, there's a surrender charge for doing that. So a 7 year might have a declining surrender charge where it's 7% the first year, and then 6%, 5%, 4%, 3%, 2%, and then the 7th year, there's no charge to surrender the annuity. And that's why I say that at the end of the term that you originally signed up for, if there's a new or better index or a new or better annuity out there, we'd be the ones to know that and help you roll that money into the new annuity. But when you first start, it's generally for at least a 7-year period of time, and then you make the adjustments annually.
Gotcha. Yeah, and I always like to make sure we give people, a very well-rounded, viewpoint of things. Good, bad, and the in between, because the informed investor is going to typically be the more successful one. I talked with a gentleman earlier today regarding, computational options trading, which was fascinating. A lot of it went right over my head, but there certainly is a lot of risk that can be inherent in that, and with things that come lower risk, at least from a pure beta standpoint, like an annuity, does come a potential for less, you know, outsized gains, right? You're looking for clients investing in annuities. You're typically looking for that security hedge. If all else goes to pot, I'm not losing my basis, and I have the potential to make some money as well. So, with that said, when it comes to security of any asset, everything involves risk. But there's kind of two parts that I'm curious about, because honestly, I don't know, is what kind of rules govern companies that issue annuities. So that way, so that way people understand, what keeps a insurance company from going rogue and losing everything, and then they can't pay their obligations. What rules govern the deployment of the capital that these companies take in for these insurance contracts or these annuity contracts?
Yeah, a couple of things. Number one, there are laws on the books, and they are a little different in every state in terms of who can even offer annuities, and if the and the rules that they have to are governed by. Um, Most people would be most all of our clients and most people in general when they're buying these various annuities, it's from very large, very stable, companies. Mass Mutual is one of our top clients. Lafayette Life is one of our top, companies. These are companies that are over 100 years old, have billions of dollars of assets backing them, are well managed and well maintained. They're AAA, with the S&P 500. They're A and A plus rated companies with AM Best, which measures insurance companies. And I think it's good advice to not chase rates per se. And if a lesser known, less sizable, less rated company is offering you rates that appear to be a little bit higher, our standpoint, you're better off with a little bit lower rates, a little bit lower participation rates, a little bit lower guaranteed rates, if it's from this type of company. Also, I'm aware of one or two very stable life insurance companies over the last 30 years that went under. And they were doing some things that they weren't really supposed to do. But I'm not really even aware of a major A plus rated insurance carrier in the U.S. that has had those kinds of problems, or just disappeared, or didn't make good on the principle of the money.
No, again, and again, I think that's where people need to understand, the risk coming into this. It certainly doesn't happen, with any regularity, but, the only one I can think of in being in investment for as long as I have would be like someone like AIG. But even they had a restructuring and acquisition, and, I don't think people, again, I don't know how their client base for the annuities that they might have been selling made out, but it certainly wasn't anything that made the news that I was aware of. But again, that is, at the end of the day, you are investing in the guarantee that a company is making. So just be aware that just like a certificate of deposit. But again, there's different protections with that. But at the end of the day, you're investing in the solvency and the ability of the issuer to make good on their promise to you to pay that rate of return with that stability that they are promising. So again, if you're talking about a company that's weathered if they're over 100 years old and they went through the Great Depression, then okay, there's something to say for that. They went through the 80s, the early 90s, the Great Financial Crisis, that. So again, it's risk is not able to be eliminated from anything, but I get what you're saying from that standpoint.
In
Now,
fact, in fact, you brought up banks, and one advantage with annuities is they are tax deferred, and the CD would be taxable. But beyond that differentiation, I would say all of the annuities that we're talking about and the companies that we're talking about are actually safer than most of the banks out there. How often do you hear about a bank going under, or a bank having problems, or a bank not being, properly managed? Happens on, not on an everyday basis, but maybe every few years you hear about, another banking crisis.
it happened last year with SVB and a few other ones. It does happen. Certainly not to the extent that it did in like six, seven, and eight, but it's not. You don't even have to look back 300 days to see it happening to a very large scale. So again, you are correct on that front.
And
And
again, if you're using the best of the best, if you're using A+ rated carriers that have been around for 100 years, and this is a big part of what they do, and they have tens of thousands of clients doing the same thing, if not more. And again, and even with the AIG, I think that was only on the variable side. I think they actually made good or sold the parts that were the regular fixed annuity side. And so even in that case where the company had significant problems, I believe the regular fixed annuity holders were made whole.
okay.
And there are, every state looks at it differently, and every state has different laws. But there are also all these companies also have to pay into different funds that help guarantee the liquidity if something like that happens.
Now, are these FDIC insurable products or no?
No, they're not FDIC insured,
Okay, gotcha.
but there are some state guarantee, like in California, there and other states, there are some, in most states actually, what they call a state guaranteed insurance fund, where these companies actually, pay into and are a part of that. And it's kind of an additional protection, for if some catastrophic event, happened to any particular company, that there would be funds to help make the annuity, policyholders whole.
Gotcha. Now, from the perspective of how these things, again, matriculate value, right? Because, it's all well and good, but if you just have money literally sitting in front of you, it doesn't make anything. It's like, oh, you didn't lose it, but, that $50,000 can now only buy $48,000 next year of goods sold. Then the following year it can only buy 43,000, right? So, we have to constantly be making sure that we are earning, right? So, from the perspective of these types of annuities, do you get let me ask the question about fixed, and then we'll move into the more interesting one of the equitable indexed equity and indexed equitable annuities one. I might be saying that wrong, but from the fixed standpoint, is the interest rate compounded on an annual basis, so that way you get compounding interest over the lifetime of that, or is it just a fixed rate of return saying, hey, at the end of 5 or 7 years, your $50,000 will now be 2% greater? How is kind of the returns compounded on the fixed side?
Yeah, most of them, whether they're fixed or equity indexed, are compounded returns. So if you earn 7% one year, now you've got 7% more that's in the contract, in the index, and if the market went up another 7%, you earn compounded, interest, and if that keeps happening, and the nice thing is, because they can never go down, you're never reversing that compounding, right? You're always locking in the most latest gain, and then you're off into the next year to see what happens.
Sure. Okay. So, um, from the perspective of the index side, right? We're looking at things that again can reset to a base value, but from the perspective of how these things are gained, again, assuming we do make a gain, the thing that we always have to consider with anything is not how much we make, but how much we keep, right? If you make $1 million in annual earned income, well, the government's going to come and take, maybe $330,000 of your hard earned money. Just thanks for playing. Now, when it comes to annuities in general, what is basically the tax treatment of the returns that are paid out on these?
Yeah. You know, it's very similar to like IRAs, any of the IRAs that you work with, in terms of they are considered long term. They are considered primarily a retirement income type product, and so generally they're completely tax deferred until you start taking them out. And the idea is that while that you're probably in a higher bracket while you're saving and while you're putting money in, and it's more during your working years. And when you're going to start taking the money out is when you're in retirement and perhaps maybe be in a lower income tax bracket, and then when the money is coming out. So it's completely tax deferred until you do start taking money out. And again, if you roll it from one annuity to another annuity, there's no tax occurring at that point. You're rolling over, you're exchanging one annuity for another annuity, and that's not a taxable event. And then whenever you do start taking money out, any money that comes out of an annuity is a taxable event. And for just for total transparency, most annuities are bought by people in their 40s and 50s and 60s, and the idea is that they're going to save until retirement time. There are penalties just like an IRA. There's a penalty if you take money out prior to age 59 and a half, or if you surrender a contract prior to age 59 and a half. So if you don't have that kind of a time frame, to look at, it may not be the best thing.
Okay. Yeah, the thing that I would really kind of maybe get a little bit more information on, I definitely hear what you're saying on, the deferment side, at least with the traditional side, right? Roth IRAs are their whole different things, but from the tax deferred side, you get money, in the IRA, you get a deduction for going in, then you pay tax on the way out. So the IRS gets their pound of flesh when you start, realizing that income. Now, is there any type of tax deduction to draw that correlation? Is there any type of deduction for the purchase or your initial basis in the underlying asset, or no?
Yeah. Well, you can own any of these annuities inside
Mm-hmm.
an IRA or a 401k or a qualified plan, and then you're subject to those rules. But even if it's outside, it's very similar to an IRA or 401k in terms of the taxation and when it's taxed. So if it is in a qualified plan, an IRA or 401k, and it's going in there, you're getting the exact same tax deduction that you would if it was any other suitable IRA investment. And then either way, it's taxable when it does come out.
Okay, but again, just so from the perspective of me just going in with my personal dollars, right? It's not like I get a deduction for buying it. It's just, kind of similar to like a 1031 in real estate. I'm deferring my gains until I actually want to pay tax on what I am, withdrawing from that umbrella of the annuities, right?
Exactly.
And then from that perspective as well, I'm assuming that probably the regulations or the taxation is probably similar from the index versus the fixed, but contracts come up and let's say, it pays out. Is there like a certain amount of time I have, let's say the contract is up, like say, hey, you know what, I want to go with a different provider, right? You have them pay out all of the earnings to you, and then you go to, you go over to you and say, hey, look, I'm done with these people. I want to do something with you. You get with the insurance providers, you get the new contracts done. Is there a particular amount of time, or is there a particular process? I know specifically from the IRA side, like people be like, "Oh yeah, I took all the money out of my 401k last year, and I got the 1099 this year. I don't want to do that. Let's put it back in." I'm like, "Oh well, this is a hard conversation to have." But is there anything similar in the annuities world to where they need to understand, hey, look, like you can absolutely change providers, you can change contracts, but there's timelines and windows, or what's kind of the process for that? You've done one, you say, hey, you know what, for whatever reason, I want to change providers or do something different. How does that work so you don't get hit with taxes?
Yeah, another great question. Generally, we're recommending, and most companies now when you're doing something like that, they want to make the transfer directly from company to company. Now, technically, you do have 60 days to roll. Let's say you put in 100,000 into an annuity, it turned into 150,000. Now it's time you decide to roll it over to another annuity. You could technically take the money and have up to 60 days to make a new decision and roll it into, um, a different annuity with someone like me, or or just directly. Um, but more and more, most of the good companies out there really don't like the liability associated with that. Because what if you sign up but you don't actually get the money in within 60 days? Then it's something that they have to worry about. And most people, when they're doing these type of plans, they'll know 30 days, 60 days ahead of time that this is what they want to do. We'll be aware of it. We'll be working with them. And when the time comes, we'll have the company A, simply transfer the entire contract to company B and literally exchange it. And it's much cleaner, much better. And you can get into a messy situation. And there isn't usually anything that's going to happen in a 60-day period of time that would warrant wanting to take the money out and then kind of starting all over again and maintaining the same tax deferral. So the short answer is, these days it's almost always a better idea just to do a company-to-company transfer.
Yeah, no, and that makes sense, but it's good to understand kind of all of your options. And again, that's from the exact same standpoint with the IRAs that I handle. I always encourage guys like, look, let's, even if we're moving, typically in an ideal scenario, we're always moving cash and capital in. But again, people change their minds. They want to go with someone different, not a problem. I always encourage them, like, look, don't have us send everything to you. Have the other company contact us, extract the assets. You don't have to touch anything, and that way you don't have to worry about the IRS come knocking because someone input a code wrong on some end or something happened. Just let the process play out to keep this thing clean and easy for you. So I definitely understand and I can appreciate the fact that those kind of processes are built into the world of annuities. Now, from an investment standpoint, nothing is ever free, right? So where's the cost basis to the client for these types of investments? Is it always just kind of built in, or is there kind of like a vig that you have to pay upfront for purchasing these contracts? Again, none of these companies have they might have been around for 100+ years, but they don't have a big red cross in front of their building, right? So, they're in the business to make money, and so are we. And again, everyone should get paid if they're providing value. I'm a firm believer in that if you're getting something for free, you're missing out on something, right? There should always be a value to what people are providing, and typically they should get paid for their time, right? I think that's a very important concept that people, at least in today's culture with investments, they always want to look at something for free. I'm like, again, Fidelity, you might be able to buy something for free, but they're a humongously multi-billion-dollar outfit. They are making money hand over fist, and I guarantee you, it's not from not charging a fee, right? They're making money. So where does kind of where's the benefit for these companies to sell this? I mean, we kind of talked about the spread on the index part, right? If it above the 10%, they get to capture all that. Again, that's fine. If it does 20% and you make 10, I think most people will be pretty happy, especially with the security or the implied security that comes with an annuity. But again, they can't guarantee that, and they're not offering these for free. So where is kind of the marketplace support itself for these? Where kind of people can expect to see fees, or how is that built into this?
Yep. So the fees, if you will, or the costs for an annuity are kind of baked into the product. And I want to back up for 1 second. Almost none of the companies that I'm aware of, they're not just buying a flat out index. They're buying an index which costs less because it only is insuring, say, the first 10% or the first 11% or something like that. So they're really not trying to put themselves in a position where the index gains 20% and they're only paying 10 and
Yeah.
they kept the other 10. That's not really what they're doing. There might be investment houses like if an IRA is with Fidelity or something like that, they may be trying to do that. But with the insurance carrier, the general insurance carriers that we work with, that's not really what they're doing.
Yeah,
But
I
what
mean,
they
there's a lot
are,
of risk, and
but
there's a
what
lot
they
of risk
are,
that comes
but
with
what
positioning
any,
yourself to make
yeah,
that, right?
but what any insurance company is doing is they're taking in dollars in 2025 and they're paying dollars out in 2030 or 2035 or 2040. And there's always a time value to the money. And all insurance companies, whether it's life insurance or annuities or even property and casualty insurance, whatever the insurance company is, that's the, if you will, that's the game that they're playing. They're taking in dollars now and they're paying out dollars as required later on. And there's a time value of the money, and they can go invest that money while it's still deferred with them or while it's with them, whether it's at 7 years or 20 years or 30 years. And a lot of annuities, especially if someone starts taking, let's say somebody put in $50,000 in 2025 and they roll it over a couple of times and in 2040 they start taking income and then they take that income over a 20-year period of time. Well, that company, the insurance company, has had the benefit of having that money on the books um, to invest over, say, a 40-year period of time, right? And they could have made, and they would typically make a lot of money on that money over that period of time. Where insurance companies have the advantage over any individual is that they can combine all these risks together, right? So we might not know how long we're going to live, so a guaranteed lifetime income makes total sense, and we're prepared whether that could be 1 year or 5 years or 40 years. Um, the insurance company has all the numbers, and they know what's likely to happen on a large group of people over a long period of time. But the short answer to your question is that they're taking money in now, and it's not all going to be paid out. Could very easily be some of that money with them 7 years, 10 years, 20 years, 30 years, 40 years out. And that's part of their overall investment pool. And they go do what good insurance companies do. They invest in other things, typically longer term bonds and sometimes a little bit of real estate. And of course, they're buying the options for the indexes to match the liabilities that they have under these particular insurance contracts. But that's the same for any insurance company.
No, yeah, and that makes sense. Again, I think people, when you think about this less as like the specific investment product, but understand that where these things are born from the insurance world, again, whether you like it or not, and I guarantee you most people don't like it, we all have a relatively good understanding of insurance. If you live somewhere like Florida or unfortunately right now California, you know it all too well. We in the state of Florida have just been hammered with it. But these companies are in the business of mitigating risk, right? And
Right.
unfortunately, that matriculates to our personal lives in lack of coverages for certain things. But that's again the name of the game is that they want to bring in, invest, pay out benefits. While maintaining that balance of bringing in more than they pay out at any one given time, which again is fair. That's how insurance works. Like it or love it, hate it, leave it. That's the name of the game, and we can leverage that to the investor's benefit by different products that they offer with that investing mantra of what they're doing of that time value of money being tied up with them for the inherent benefit of saying, hey, look, I have a very secure investment position that is going to pay out a defined rate. Now, from the perspective of how these things again pay out, which I think is kind of a good way to transition towards the back end of this, again, we've talked about kind of how the capital is, how these things are acquired, how the capital is deployed with the actual provider, what the different options are, whether they are indexed or the fixed ones. But again, to the index ones, I think it's probably a little bit more attractive for our audience base of wanting to understand maybe some more of the more cutting edge ones. And I'm sure these things have been around for quite a while. But once these things again matriculate and you have that renewal period, how are the benefits? Is there a point at which time you will have that kind of payment schedule that you can kick in by saying, hey, look, I've invested 50, we've rolled it over for X number of years. Now let's start paying out this payment stream from this, or do you kind of have to, on an annualized basis with the index stuff, say, hey, look, instead of rolling over the compounded return, let's distribute it to me? What does that look like?
Yeah. Well, first of all, most of our annuities, whether they're fixed or indexed, do allow you to take out up to 10% without any penalty. Generally, it's at retirement time and you're paying the tax on that. So that's one way. And some of our clients, instead of what we call annuitizing, they simply want to do that. Let the index annuity keep growing, and then, or not. And then each year be taking, say, 10% out as part of their overall retirement, plan, or mix and matching it with other investments so as to minimize their overall, tax gain. And then an equal number of clients will say, no, I really like this idea of a guaranteed lifetime income. My 50,000 turned into 100,000. So now tell me, how much will the company pay me, or me and my wife? There are joint choices as well. Pay me as a guaranteed monthly income for as long as I live. And that used to be an all or nothing kind of a decision, where if you died 2 years into it, that was it. Or if you didn't have a joint indexed annuity and both of you didn't live a certain amount of time, it was kind of a negative, because they did insure that for that period of time, but then you died and didn't get those benefits. Most of the modern annuities out there now have a refund for the amount of money that wasn't paid out, that would have been paid out under the guaranteed lifetime income. So let's say you had 50,000 turned into 100,000, you started taking out 10,000 a year, or it was paying out, say, 7,000 a year or something like that, as part of your overall retirement income. That then if you died in the second year or something like that, you would get a refund for the amount that was in the contract that hadn't been taken out for the income. So generally that's how it works. And again, one of the really nice things about annuities, whether you're just taking it out on a regular basis on your own and letting the rest grow, which is a great strategy, but this whole idea of having a guaranteed lifetime income, because a lot of times people in retirement will tell you, you know what, I have all this money and the whole idea was to save for retirement, and the kids are all grown up and on their own, our house is all paid off and whatnot. The whole idea was to have retirement income that we can enjoy, that we can travel, that we can enjoy our grandkids, that we can do other things that we didn't have the time for while we were working, that we were planning on doing when we were in retirement. But then at retirement, they don't want to spend it all, or they don't want to spend what they were planning to spend, because they want to save some for the kids, or they want to make sure they don't run out of money. And so they won't truly enjoy the retirement that they were creating for themselves because of this limitation. It's a personal limitation, but it's very real for many people. And so they'll not take the money, or they'll not take all of it, or they'll not take 10%, or they'll not take the money that they thought they were going to take out for those reasons. And those are good, legitimate reasons. So the great thing about a guaranteed lifetime income is you're going to get that check every single month, whether you need it or not. And you know that another one is going to come the next month, and the next month, and the next month. So if all of your fixed expenses are covered and you get this money, why not enjoy it? Why not use it? Why not visit the grandkids? Why not do that traveling, if your health permits, that you thought you wanted to do? Why not, go out more? Why not go to the theater more? Why not go to restaurants more? Whatever it is that you would like to do, that you were planning to do, that you were saving so diligently for, now in retirement, when you can have the time and the money to do it, this allows you to do that, because then the next month you're going to get, money again. One of my favorite mentors in this business is a guy named, Tom Hegna, Hetna. You can look him up. He has a whole series of videos on this whole idea of guaranteed income for life or lifetime income, and why people who are getting these guaranteed lifetime incomes actually live longer, and they actually live better, which is the whole idea of retirement and saving for retirement to begin with, because they know they're going to get the same check every month for as long as they live, or a joint check for as long as they or their spouse is alive, for as long as they live. And that's really what their whole purpose in retirement planning was. And because they know it's going to get renewed every month, it's the permission to go spend that the way they originally thought without worrying about. And then if they want to leave money to children or charities or other, that's what life insurance is for. That's what other assets are for. But these were, either whether they're in a qualified plan or not, the whole idea was to accumulate safely money for retirement. So here it is, use it that way. And I get in these conversations more often than you might imagine, where people just, especially if they were good savers, they just don't want to spend it. And there's a lot of people that get to age 73 and we tell them, you have to spend it. You no longer have the choice. The government is telling you that at age 73, whether it's in an annuity, in an IRA or 401k or not, or if it's just money in an IRA or 401k, they still want to keep deferring it. And the logic is sense, but even at that point, the government is telling them, no, you have to start taking it. You have to start paying the taxes on it. It wasn't a tax-free forever, thing at some point, and now it's age 73. You have to start taking that money. So we kind of take it a step further. It's like you should want it. That was the whole point. And when you can have a situation where you have a guaranteed lifetime income, it allows you to do just that.
Yeah, no, absolutely. And those are all great points. I think that's kind of a good place to bring it in, for a landing on this, is that, there are products out there that can offer, again, high degrees of stability, with, again, you always have to look at what your, expected, return, what you're aiming for. And there are different annuity products. And again, so many people, at least in my, general peer group, right? You think of annuities and you think of your grandparents, right? It's like, oh yeah, an annuity, cool. Like I put it in there. I think my grandfather has one, or maybe my parents have one. It's again not exactly something that you look for, necessarily an outsized return, right? But you do get a high degree of stability. You get very low risk with a fixed rate of return, and also understanding there's different products out there that can offer higher rates of return that might be a little bit more fluid, especially with the indexed annuities, which, again, for anyone looking for a really well-rounded view of personal finance, again, just because it's not something that I necessarily invest in doesn't make it something you shouldn't, and you certainly shouldn't ignore it, right? So annuities have a great place for the well-rounded investor, and especially with the indexed ones, where you can have that potential ability for at worst, your basis is protected. At best, you have a solid rate of return that's going to be paid. And there's some pretty cool calculators out there too that you can look at, of saying, hey, look, you invest this much. Okay, and let's say in 2006 it made this, 2007 it made that, 2008 you made nothing, as far as a gain, but you didn't lose anything, and kind of see how these things work. And I'd encourage our listeners, go and check that out, because it really, when you can kind of see how this stuff plays out over, 20, 30 years, depending on, if you're 70, maybe, don't run the 30-year calculation. But when I say that, my grandfather's 92nd birthday was yesterday. So people are living longer, but there's definitely, stuff out there. Just because, it may seem a little old school doesn't mean that it's not a viable option. And also, there's a reason these things are still around, and still a lot of people enjoying the benefits of these. So if people want to learn more and kind of get more ingrained in these kind of products and the insurance products, how can they reach out to you, Stephen?
Yeah, well, let me give you my 800 number. Anybody can always call. Our 800 is 800-245-4677. They can reach me on my regular email, which is my name, Stephen Stepp at sbcglobal.net, Sam Baker Charlie Global.net. Or you can, I think you can go directly to my LinkedIn page by just typing in connectwithstevestepp.com. and the first thing that come up is the LinkedIn page, and you can certainly approach us that way as well.
Hey, fantastic. Well, again, really great information. And again, the first time, which I'm surprised in almost 200 episodes that we've had someone on talking about annuities, but I certainly learned some stuff today. It's if someone asked me about the kind of annuities, I probably would have told them, well, there's fixed and there's index ones, but I had no idea what an indexed annuity was before this conversation today, which I always really enjoy being able to get to learn, along with our listener base about new investment products. At least for us, again, these things aren't inherently new by any stretch of the imagination, but just getting to expand my knowledge, because too often we find our avenue when it comes to investing, but we don't ever really kind of take the time to step back and look at all the options out there. Again, I'm always really hyper focused on the alternatives, real estate, private stock, new things, cryptocurrency, but there's value everywhere in here, and depending on what your goals are, the cool thing about finance, at least in the United States, is there's so many different interesting products out there that can really suit a specific need very well. And again, annuities definitely play right into needs of certain clients, and they certainly shouldn't be overlooked. So Stephen, again, thank you very much for your time today. The most valuable resource we all have is our time, because we can't make any more of it no matter how well we invest. So thank you very much for being on with us today. I want to thank all of our listeners today for being on with us. Again, this is the Alternative Investing Advantage podcast. My name is Alex, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.